Justin Harrison is our keynote address. For many of you who listen to East Coast Radio, I'm sure you would have heard his radio presentation. He's a financial personality. He's written a number of books. He's certainly a man in the know, and he's going to be chatting to you sort of more around an overview discussion around financial aspects. Maybe you'll learn something, maybe you'll teach him something. He's quite a young guy here. I'm sure we can teach him a few things. And after that, we'll have a comfort break where Malcolm will be serving some snacks. And then we're going to come back to the room and have this panel discussion.
Thank you, Louise. Thank you very much. I have a very loud voice, so if we don't need the mic at some point, I'll put it down. I'm going to try and keep it quick and to the point. I certainly am in front of a lot of distinguished people here. That's a nice way of saying slightly older people. And as Louise said, there definitely is some lessons I can learn from you guys. But of course, in the world of money and finance, we are living in changing times, and there's a lot of stuff happening in the world, and a lot of people are uncertain about what's happening in the world right now, especially when it comes to the investments and money. And so my journey into money is very unique. My insights into money and finance is very unique. And I'd like to share some of those thoughts with you guys today, especially a collection of questions that I get a lot from people who hear me on radio, see me on TV, and of course then present some of these questions to me. So of course, I don't do PowerPoint slideshows. We were joking about this earlier. I think that you guys probably would appreciate that. We are here to have a one-on-one discussion. If you guys do have questions, please come and approach me afterwards. We will have a panel discussion as well. And before we get going, I'd just like to say thank you to 10X and of course to Estate Living, Louise, for making this event available. I think it is absolutely critical that we get people out of their homes, that we talk about money, that we talk about investing, that we talk about finance, because sometimes we can sit in our own homes and we can sit inside our own heads, listening to the news, listening to things, and there is often a disconnect with reality. So today we're going to talk about some of those realities. So the topic for today's discussion that I was presented with actually happens to be the most common question that I get asked, is where should I invest my money? So a lot of people obviously facing these uncertain times in the world right now are asking, where should I put my nest egg? Should I be taking it offshore? Should I be putting it into a specific investment? What is going on? And it's actually the wrong question to ask. Where you should invest your money is actually the last question you should be asking. And I know a lot of you guys are looking at me very surprised, but I'm going to explain exactly why today. Not only is it the wrong question to ask, but it highlights the challenges faced by investors, you as individual investors, the lack of knowledge in the marketplace, the lack of access to information. And as I said, today we're going to go through and highlight some of the questions that people ask me. I get a lot of people stopping me on the street, they've heard my radio shows, and there's common questions that people ask me all the time when it comes to investing. So I want to give you guys a little bit of context to my personal background. Louise touched very briefly on the fact that I'm on radio, I'm on TV, but I think there's a deeper story here, and I think it's important to understand the context of the information that you're getting, because where you're getting your information from is as important as the information itself. So like I said, my journey is a little bit interesting and a little bit unique when it comes to money, because in the world of money and finance, I'm definitely not normal. I don't comply, I question everything, and I don't trust anybody when it comes to money, especially not if they have an FSB license. And by the way, I have FSB licenses, I have NCR licenses, I have all the licenses. And I've spent the last 20 plus years building businesses in the financial space. What is absolutely unique about my journey into this world of finance is that I grew up extremely poor. And like many people in this room, probably faced the similar challenges, came into the world with very little, and I had to figure out how to survive. Now, I have a total obsession for numbers, and I have an obsession for compounding. It's something that 10X guys, I think, would appreciate. You guys who are in a later part of your life will understand the value of compounding investments. Small incremental gains over the lifetime of your portfolio is really where it's at if you want to be successful with an investment portfolio. But I think the biggest advantage I've ever had in my life when it comes to money is that I've been homeless. And the reason why I say it's the biggest advantage I've ever had is I learned something by being homeless, is that money as a resource is the only thing that's keeping you from the street. It keeps you in this lovely estate, it keeps you with medical care, it keeps you with all the advantages that keeps you safe and warm. And when you understand that money is a resource, you detach from it emotionally, and you start looking at it exactly like that, like putting petrol in your car, providing medical cover, providing a lovely estate to live in, and you stop seeing it for anything less. You understand how to manage it. You understand how important it is. And it is just like any other resource. It needs to be managed. Unfortunately, the world over, it's a resource that's not being managed very well by governments, by individuals, by companies. And so that is something that being homeless taught me. When I finally got back up on my feet after many years and figured out how the world of finance works, I've started to understand capital deployment, how to use capital to gain financial freedom and ultimately create the lifestyle we all ultimately desire, which is one of freedom, where our investments work for us. So a little bit of business background on me, which a lot of people don't know. I've started over 100 companies, and a lot of those companies have failed. And as I look out on the audience here, I'm sure there's a couple of entrepreneurs, ex-entrepreneurs here. You guys know building business is not easy. Building a business is extremely tough. I've had great success and I've had great failure, and I've learned a lot of things through that. Many of these businesses, like I mentioned, have been in the financial sector. But what's unique is I've built most of these businesses without any funding. I've never gone to investors to raise capital. I've never gone to the markets to raise capital. And the reason I'm telling you guys this is because this makes me, morning, Dennis. The reason why I'm telling you this is because where I come from in creating these businesses, the thing that mattered most was turning a profit. If I couldn't turn a profit, I couldn't create a successful business. And I carry this philosophy across to whatever I invest in. I don't invest in something if I can't turn a profit, if I can't make a return. So I am super aggressive about profits. When I look at investing, I look at it very differently than the traditional investor, because I've started businesses, as they say, bootstrapping, with absolutely nothing. And I look at my investments the same way. When I look at an investment, I scrutinize every single aspect. I look at the risks, I look at the rewards, I look at the potential, I look at everything. And I think this is something that I've carried across from entrepreneurship into investing, which makes it very unique. In terms of my investing background, I started investing, like many people, initially into real estate, into property, as we like to call it here in South Africa, and then eventually into unit trusts, because, you know, that's where everybody's told to invest. And then I started to self-invest into stocks and bonds. I entered into the stock market, I entered into the bond markets, especially overseas, and later I started to go into private equity. Keep in mind that my primary investments have always been my businesses, because they give me the highest return. But ultimately, when you make money in business, the objective is to put it somewhere, to put it to work. Today though, and this is going to sound like a little bit of a Frank Sinatra moment, but I'll invest in anything that makes money. Anything that makes money. As long as I understand it, and as long as I can see the returns, I will invest in it. And the world is full of investment opportunities. There are so many investment opportunities outside of the traditional space right now. There is so much opportunity, and I say this to a lot of youngsters today. They have opportunities today that your generation never had. And my generation specifically is on the cusp of it. We're in that midway point. But there are things like crowdfunding. You can invest in shares in real estate through real estate investment trusts. There's just so many opportunities out there. But it all comes down to 3 simple rules, for me anyway, when it comes to investing. And I hope somewhere this will ring a bell for you guys. If you're ever sitting with a broker, if you're ever sitting looking at your investments and questioning yourself, these are my 3 simple rules for investing. Doesn't matter what the investment is, doesn't matter how complex it is, an investment has to do 3 things for me. Number 1, it has to preserve capital. looking out on this room, I think capital preservation is probably one of the most important things for you guys. Secondly, it has to cash flow. Maybe a little bit different for you guys, but for me, it has to cash flow. I'm super aggressive about cash flow. And then thirdly, it has to appreciate in value. The asset has to appreciate in value. Those are my 3 rules for investing. So naturally, property and real estate has got to be one of the cornerstones of my property, part of my real estate, part of my investment portfolio. Real estate is one of the few vehicles that ticks all 3 of those boxes. So you find a lot of investments that will appreciate over time, that will preserve capital. Gold is a classic example of that, but gold doesn't cash flow. That's its one shortcoming. So gold does have a place in a portfolio, but understanding what it does is important. Preservation and future value, but it doesn't cash flow. So understanding these different asset classes is really important. And for me, when I'm investing, it comes down to those 3 things. I was listening to the sentiment, I was watching the economics. I avoid the news completely, but I do watch economics, and I watch economic data very closely. And so 8 years ago, I started to offshore my businesses. I offshored my companies, I offshored my personal structures, I offshored my banking, and I've spent a considerable amount of time understanding what the options are as a South African. And I can only speak to this as a South African. I can't speak to it as an American or a UK citizen. I can only speak to it as a South African. I've spent a considerable amount of time going overseas, traveling overseas, and figuring out what is plan B. And let's face it, we all sit around the dinner table and go, what is plan B? If the poo really hits the fan, what is plan B? And so I stand in front of you 77 countries later. I've invested in a lot of those countries. A lot of them I've lost a lot of money. I've built up real estate portfolios in some of those countries. I've built business portfolios in some of those countries. And I can tell you that the grass is not always green on the other side. We have real problems the world over. It's not just in South Africa. But what I do believe, and what I have experienced through this process, is that the one thing that can save you, whether you decide to stay here with all your money or you decide to put some of your money overseas, diversification is everything. You have to diversify. Nowhere is perfect. 77 countries later, numerous lawyers, numerous immigration people involved. I can tell you the only thing that's going to save you and your money is diversification. There is no perfect currency, there is no perfect country, there is no perfect government. It doesn't exist. So I make every decision now based on a very simple theory. I go where I'm treated best. And I look at where I'm treated best in different containers. I look at banking, I look at taxation, I look at residency, I look at cost of living. I look at everything as a totally different container. And this might be a little bit more difficult for some people to grab hold of, especially because we're living in such a globalized society now. But the world has changed so much. You can live here and bank somewhere else. You can live here and pay tax somewhere else if you have the correct structures. Gone are the days where you have to live here, pay tax here, bank here, and do everything here. And if you have a couple of million, you don't have to be ultra wealthy, but if you have a couple of million and you have the right structures in place, you can live what I call the flag theory. The flag theory is about taking a flag for every specific container and planting it in the right country. So if banking is best in Mauritius, we bank in Mauritius. If taxation for our structures is best in the Seychelles, we do that in the Seychelles. If we find that, for example, we want to avoid estate and death duties, and that may be better in the Isle of Man, we do that through the Isle of Man. Now, there are some practical challenges to this. I will give you one of them as an example. I have to spend a certain amount of time out of this country. And if you guys want to know more about that, feel free to ask me afterwards, because we can go down a long road talking about that. But there's a lot of options available. The point I'm trying to get to is that I've spent the last 8 years of my life and millions of rands on what I would like to think of as the ultimate estate planning. Because when people think about estate planning, they purely think about death and handing over to their children. I like to think of estate planning as, how's my wife and I going to live in our later years? How is taxation going to affect us? How is the cost of living going to affect us? And ultimately, I want to live in a place where the cost of living is relatively low. I want to reduce the amount of taxation I'm paying. And I want to keep my assets where they're fairly safe. And I think everybody here can logically understand that. And practically, there are options available out there. It's just that the dots are very hard to connect, because lawyers don't speak to accountants, and accountants don't speak to immigration people. And it takes somebody like me who hates paying tax and who despises the government and despises all these things that are being put out around us to challenge this. And there are a number of companies out there starting to do this sort of thing. And I've dedicated 8 years of my life to it. So, with that in mind, I do want to point out that South Africa is an absolute mess. I don't need to tell you guys that. I think I'm preaching to the choir here. I'm sure if I had to be a fly on the wall here in Club de Vie, there would be a lot of complaining that goes on. But I'm going to state the obvious, and you guys will see why in a second. But I'm a businessman, and I sit around boardrooms every single week. I sit on, I'm on board of trustees for a number of prominent financial companies, and I can tell you the tail is wagging the dog in this country. You guys might talk about it amongst yourselves. I'm telling you from the top down, the tail is wagging the dog in this country. We have labor dictating to business, and for as long as that is happening, we have a problem in this country. We have a communist socialist agenda in this country which directly competes against our capitalism, which is going to drive this economy forward. For this economy to go forward, we have to drive it forward with capitalism. And unfortunately, socialism and communism is competing against it. How this plays out, none of us know. We can surmise. It isn't really important. We have to look at the economic data in front of us. That's what's important. Domestic politics is a total joke. We all know this. Turn on the news. But I think there's an underlying issue which very few people touch on, and very few people have paid attention to. And whether you agree with me or not, this is a categorical fact. For as long as we have resources under our feet in this country, there are Western interests that will destabilize our economy. Because it is not in the West's interest for us to have a strong democracy, a stable currency, and a stable economy, because it makes our resources more expensive. It's as simple as that. So accept that no amount of voting, no amount of petitioning, no amount of anything is going to change the fact that Western interests are playing out right on our doorstep. I know people don't like to hear this, but it's something you have to hear, because it translates back directly to what you decide to do with your money. If you're hoping for a better and brighter day from a politician, you're going to wait until the day you drop off this earth, and then some. That's just the reality. The macroeconomic outlook is bleak at best. I've looked at the numbers. I've done financial graphing. Besides the inflationary pressures that we are facing, and we're facing real inflationary pressures in this economy that, by the way, are dramatically pushed on us from outside, the number one problem we are facing, we are becoming a net importer of everything. There are very few industries where that scale is shifting the other way around. From manufacturing to agriculture to everything, we are becoming a net importer of everything. And it's becoming dramatically worse over time. The macroeconomic picture is bleak for South Africa. And I don't say this to scare you guys. I'm saying it to prepare you in your thinking for how you invest. And of course, everybody can see the rand is depreciating every single year. But let me point out that the rand doesn't depreciate just because of domestic issues. the rand depreciates because of external factors just as much as internal factors. In fact, mostly because of external factors. So that's something just to keep in mind. Everybody says the rand has gone down, South Africa's going to the crapper. Fact of the matter is, the rand is under pressure because of external factors in the fiat monetary system. And again, I don't want to get too far off topic, but we can go down that road for 3 hours. So, I hope you guys are all still with me after that gloomy news, because I have even more bad news. Unfortunately.
There's no good news.
There is some good news, but you have to go through the bad to get to the good. The world is a total mess right now. The whole world is a mess. Turn on the radio, turn on the TV, the world is at war. We have geopolitical tensions playing out. If you're watching East versus West right now, it's not looking good. I mean, we're on the brink of World War III, if you to believe CNN. We have the dollar as a reserve currency is under threat and may not survive being the reserve currency long term. Personally, I think this is a great thing, and I believe it is the single greatest wealth opportunity presented in our time. The dollar is worth nothing. They've printed so much of the stuff, it's not underpinned by gold anymore. The gold standard was abolished. Again, we can go down this road for another 2 hours. The bottom line is, America has been absolutely reckless in the way they've managed the dollar. And unfortunately, our currency is directly linked to it, as is the rest of the world and most of the major commodities. So I think it would be a really good thing. BRICS, by the way, is a really good thing, but there's going to be a period of major upheaval and uncertainty. There's record high money printing around the world, not just in the US. We've seen what happened in Cyprus. We've seen what's happened in large parts of Europe. Quantitative easing, which is the printing of money, is a major problem in the financial system. And then, of course, you guys can definitely attest to this, the rising cost of living. Those macroeconomics translate directly into your pocket. When you go to the shop, when you go down to Spar or to Woolies, everything has got infinitely more expensive. The bank tells you CPI is sitting at 6% or whatever it is. Woolworths inflation is like 10%, 15%. That's real inflation. And then, of course, the increasing wealth gaps the world over. This is a reality. We've got, it doesn't matter what country it is, the wealth gap is increasing in every single country. The rich are getting richer, the poor are getting poorer, and the middle class, they're either finding their way to the top, but most of them are finding their way to the bottom. And this is what's happening. So, the problem with all of this bad news and some of the good news is that people tend to lean into what I call sentiment investing. And the problem with sentiment investing is that people are very much basing their decisions on where and how and what to invest into based on what they're listening to, what they read, what they see. And the majority of people are listening to CNN, Sky News, BBC Radio, back here, the local radio stations. And the truth of it is, the media is completely out of sync with reality. And I'm going to, unfortunately, there probably are a few rare instances out there. But let me give you guys an example. When we talk about stock market investing, and so I'm going to try and keep this really simple for those of you who haven't done stock investing. For those of you who have, will understand exactly what I'm saying. A company is valued by what's known as a market cap. And the market cap is basically the number of shares outstanding multiplied by the share price. That's the market cap. So the market cap of this company is $1 billion. Total number of shares multiplied by number of shares outstanding. The share price is determined by whatever you and I are prepared to pay for it. If the news is good today, we all pay more. If the news is bad tomorrow, we all pay less. And that affects the market cap. It comes down. But go and do an actual proper financial calculation on the company. Add up its assets. Add up its liabilities. Look at the financial statements. Go and value that company as if you were going to buy that whole company with your own money. And you'll find there's a complete disconnect with what the companies are worth and what the market cap is worth. That's why you have got companies on the stock exchanges. $10 billion valuation. and they've never made $1 in profit. It's all based on paper. What I'm trying to get across is that sentiment drives price. Sentiment drives value. And so people use sentiment when they're investing. And it is quite possibly the biggest mistake you can make, because our sentiment is driven by our input, and the input isn't always correct. And here's another example. Do you know that the wealth gap in America is growing faster than the wealth gap in South Africa right now? As a percentage, of course, we've got more inequality here, but the actual wealth gap is growing faster in America. You won't hear that on CNN, but if you go study the data, it's there. So I believe that sentiment-based investing is not only irresponsible, it's downright dangerous. And so you've got to be very careful when you're making any decisions. Turn off the radio, turn off the news. Focus on the numbers. I was saying this earlier to the guys at 10X. I focus on numbers. I don't focus on sentiment. So I don't listen to the news. I follow economic data. So most people in South Africa, and probably you guys can relate to this directly, are looking for security. And this is why people look towards first world countries. Should I take my money to America? Should I take my money to Europe, to the UK? They're looking for security. Should I go buy a property there? Should I put my money there? The reality of it is we are living in shifting economic times more than ever. And if we can't see that around us, I think you might be half asleep, because the world is shifting. The dollar's under pressure. China versus America, Russia versus America, the world is a mess. And I believe these, like I said, times present massive, massive opportunities. But I want to talk to you guys about first world markets, because I've hammered hard on how South Africa has got its challenges, the first world's got its challenges. But I want to talk specifically about first world markets, because a lot of South Africans, especially in this age demographic, are very worried about their money, very worried about what's going on here, and saying, should I take my money overseas? So I generally don't like first world markets. I generally don't like them, except for real estate and except for stocks. I find that competition is very high in first world markets. I find that returns are generally low, and I find that the markets are generally over-regulated. And often that regulation doesn't stop a lot of the problems that we see anyway in developing economies. Taxation is generally higher in first world countries, with a few exceptions. Banking is usually horrible. And if any of you bank or have a bank account overseas, you're going to relate to exactly what I'm about to say. The interest rates are shocking. You're losing money putting your money in the bank overseas. Now, in terms of developing economies, some of the benefits are there's a broad spectrum of opportunities. They do obviously come with additional risk, but diversification can help you avoid those risks. There's a significant tax breaks for institutional investment in developing economies, and the returns are obviously higher, but you have to manage your risk. So the topic of today's discussion is obviously, if you're not asking the question, where should I invest? What should you be asking? What are the questions you should be asking if you're not asking, where should I invest? So here are some of the questions you should be asking. You should be asking yourself, you should be asking your brokers. These are the questions you should be putting forward. What should you invest in? Which asset class? That's the most important question. What asset class? Second of all, what are your objectives? Is it capital preservation? Is it growth? And this is going to change depending on your life circumstances. How much money you've got, how many kids you've got, how many dependents you've got, how many years you've still got to live, your medical condition. There's a lot of variables that go into it. But are you leaning more towards preservation? Are you leaning more towards growth? This will determine the kind of investment you're going to make. And most people are allowing brokers to make these decisions for them. It's a mistake. You need to be understanding what your needs are before you go to a broker. You have to understand what it is you're investing into. The amount of people that say to me, I'm invested in this fund, I'm invested in that fund, and I say, okay, what assets are in that fund? I don't know, ask the broker. I don't know, I get the papers every month. It tells me how much money I've got in there. What you've invested into is paper. You don't understand the assets. And the amount of people who then lose money down the line and then blame the broker, it's not the broker's fault. It is your job to look after your money. You have to understand your money and you have to understand what it's invested into. I mean, if we've seen what's happened with Steinhoff, Steinhoff pulled a massive heist on everybody. And I think a lot of investors could have been spared if they asked more questions, but they relied on other people. Come back to the 3 questions. Does it cash flow? Does it appreciate in value? And of course, does it preserve capital? Are the assets easily transferable? This is a super important question. Are the assets easily transferable? Because if you're moving between countries, a lot of you might have kids that are immigrating. A lot of you might decide, well, you're done with South Africa. A lot of you might decide, well, actually, I might want to live a different kind of life. There's a lady sitting in the front here who's talking about might want to go farming with a community and set up a sustainable living environment. And so the bottom line is you want to make sure your assets are easily transferable. As easily transferable assets are, the more committed you are to them over a period of time, the less ability you have to change course if you need to. What are the tax benefits to owning the assets, the investment? Tax is one of the major eroders of wealth. You have to look at the tax benefits of owning investments. One of the reasons why I like real estate, there's a lot of stuff you can write down in terms of the tax benefits. This is one of the reasons I'm really big on property, but you have to have the right vehicles to do it. 10X is definitely going to love me for this. I promise you it's not an advertisement. But what are the fees? Fees can make or break your investments. Literally, fees can make or break your investments. And I'm gonna give you a simple example. A 0.75% increase in fees equates to a 30% smaller nest egg in just 20 years. Let me repeat that. 0.75% increase in fees means you will have 30% less in your nest egg in just 20 years. So I hate paying fees. I hate paying fees and I hate paying tax. So, should you send all of your money offshore? That's the next big question I get. The answer is absolutely not. That's my opinion. It's not financial advice, based on my own personal experiences. 77 countries in, lots of financial structures. I don't believe you should. But you must hedge against a devaluing rand. The rand is devaluing. We have to hedge against it. But guys, you have to work and hedge against a devaluing fiat monetary system. The dollar's depreciating. The pound, the euro, everything is devaluing over time because they're printing so much of the stuff. Over time, that's why we've got inflation. There's too much money being printed. So, in order to hedge, you need physical assets. You need commodities. You need physical assets to underpin your investment portfolio. And don't ever let emotions get in the way of logic. When it comes to offshoring, the discussion always comes back to emotion. Most people look at offshoring because it's emotion that led them there, rather than logic. Of course, a lot of people talking about wealth tax at the moment. I won't go too deeply into it. I'm sure there's a couple of very wealthy individuals here, hopefully. And the reason I won't go into too deeply because we still have to see the advent of what would happen if it does happen. And of course, a lot of it's going to be an opinion rather than once it's actually happened. But here's what I believe is important in the event of wealth taxes happening. And they are, in my opinion, going to happen more aggressively over the next while because the world over, the rich are being targeted. First of all, having a good tax advisor as part of your structure, your estate planning is going to be very important. You're going to have to be super tax efficient. Understand that tax is something you can always work around if you're smart enough. Your estate structures are going to be really important. Having trusts, having companies to own some of the assets that you own, these are going to become way more important than simply having things in your personal name. I personally am far more concerned with governments prescribing assets than I am with wealth taxes. A wealth tax, we can dodge and dive. We can figure out how to move. But when they prescribe assets, we have a real problem. And this is one of the reasons I'm personally in favor of retirement plans that allow you lots of flexibility in terms of being able to transfer assets. The greatest threat to wealth is not tax, believe it or not. It's inequality. Because inequality in a society means you're going to be paying privately for health, security, schooling, etc. And we see it right here. And those are the things that erode your net worth at the end of the day. So take all of that into consideration. The solution, of course, is always to stay diversified. Diversity, diversity, diversity in everything. In your structures, in your money, in your investments, everything. This discussion could probably go on for a long time, but one of the questions that came up, Louise actually asked me to talk on this. It's come up to people who've met me in person from the radio shows as well, especially in your age demographic. Should we be buying our kids a home? We've got some money, kids are struggling to get on the property ladder. Should we help them buy a home? What is your opinion? The answer is absolutely not. The answer is absolutely not. And I'll tell you why. Kids today especially need to understand money. And generational wealth is not simply a case of handing them a bucket of money and handing them an asset. It's like handing a loaded gun to a monkey. Sorry, I'm not referring to any of your kids as monkeys. But you have to hand with it the education. So unless you're prepared to hand that with it, the answer is no. But if you insist on buying your kids a home or an asset, such as a home, an asset, my advice is to do the following. And it's what I will be doing for my 3 children. I have a trust that will purchase the properties. The trust will own the property. The kids will pay rent to the trust till the day I drop off this earth. In which case, they will get the benefit of the property and they'll get the benefit of all the money they paid into the trust, which will teach them 2 valuable lessons. It'll teach them the value of looking after an asset and accumulating wealth, and it'll teach them the benefit of compounding an investment over time and the discipline that goes with that. And I think that is, if you're going to hand over property to your kids, the most logical way to do it. It also, from an estate planning perspective, happens to be the most logical as well, because it means less taxation if you're doing it through a trust. And that is true generational wealth. So, let's quickly tackle one last question, and I'll give you guys some final thoughts, and then we'll break. So, a lot of people ask me, how do you know if an investment is a scam? Just a quick show of hands. Anybody been scammed out of money here? Okay, so I actually don't even need to preach this to anybody. Okay, one person. One person. I saw you looking very angry in the back there, so I had a feeling. So I'm just going to reiterate stuff that you guys already probably know, but I get asked this question a lot. How do you know if an investment is a scam? Well, the first one is unrealistic returns. Unrealistic returns. Okay? 10% is good. This is my rule. 10% is good. 15% is exceptional and comes with risk. 20% is gambling, what I like to call speculation. Now, I've got a lot of speculative investments that make me more than 20%, and I'm very happy about it, but a lot of those investments also lose me money. But I'm okay with admitting it's a gamble. Capital preservation, we're going 10%. That's where we're heading for. You want to look for track record in investments. You want to dig deep. How many people hand over money without checking the track record of a scheme, of an investment, of a broker, of the person they're dealing with? Make sure they're registered with financial entities. I'm not saying this is always going to save you. A la Steinhoff, we've seen that. I mean, they pulled a magical scam there. But do the work. Make sure, are they registered? Have they got licenses? It's one additional barrier. Look online. Most people are internet savvy these days. Go and look for complaints. Go and see if there's previous clients who are complaining. Google reviews. Go look for forums. Trust your instincts. There's always that voice at the back that is going to tell you this is probably not the right thing to do, but most people override that voice because of fear and greed. The two emotions that drive every loss, fear and greed. Fear of missing out, fear of not getting the return, and of course greed. We want the return. Those are the two things that ultimately drive losses. So here are my final thoughts and lessons on investing in terms of how I've built my wealth, where I've put myself in this position to be what I consider to be exceptionally fortunate. Diversification is like insurance. It's the ultimate insurance in terms of investing. Tax is an expense, the way I see it, and you have to save on it just like any other expense. So find the most tax efficient structures you can. Fees will erode your wealth faster than anything else, so you have to reduce the fees as much as you can, because over time fees will absolutely erode your nest egg. Sustainability is the key to investing. Whatever you do, you have to do it sustainably, constantly, and over the long term. Knowing what you are invested in is as important as being invested in the first place. Don't simply invest in paper. Know the assets that you're invested in. If you don't understand it, if you don't understand Bitcoin, don't buy Bitcoin. If you don't know how to buy Bitcoin, don't buy Bitcoin. Don't get somebody else to do it for you. That's how AfriCrypt ran off with millions of rands of everybody's money. If you don't know how something works, don't get involved. Don't rely on brokers. Sorry, 10X, but I have to say it. Make sure you understand your money. Brokers are facilitators. They are not there to make the decisions for you. They are facilitators. You need to understand your money. The only thing anybody else in this world is going to do with your money, help you do, is take it away from you. I don't trust anybody when it comes to money. And my last and final point, question everything, question everyone. Thank you very much, ladies and gentlemen. Thank you.